Hello, everyone, and welcome back. My name is Austin Hageman, and I am an advisor and partner here at Withum Wealth. And I'm joined today by Henry Mercer, our Chief Investment Officer. Today, we're going to walk through a handful of slides from our quarterly market update. These are all a small selection of the types of data points our investment committees review internally, but our goal today is not to overwhelm you. We'll pick a few slides here out of the deck, and our goal here is really just to help you understand what matters, what doesn't, and how to think about markets without getting pulled around by the various headlines. As always, feel free to drop questions into the Q&A and we'll try to hit them throughout. So we do, as usual, have some viewers who aren't clients. So a very quick background on the firm. Withum Wealth is a multi-billion-dollar independent registered investment advisor. We work with high net worth and ultra high net worth families and institutions. We have both clients that only use us for wealth management alone, but many of our clients also work with us, with them on the accounting end, which adds to the offering itself. For those clients, we can create a cohesive family office type offering around them because of all the expert professionals from different areas we can add to the table who can all be working for your benefit, and you don't even need to be in the room. Unlike most of the investment industry, we exclusively register as an investment advisor. We do not register as a broker, which means we always have to act in our client's best interest, and that is very important to us. There's no commissions, no product sales, no hidden incentives on our end. Clients pay us for quality wealth advice and investment management, and that's it. We have institutional reach, which gives clients access to multiple private banks and other third-party providers. But also on the investment side, our institutional access gives clients a wide open investment universe, not one shaped by revenue sharing deals or other financial incentives. All right, let's jump in. So this is the time of year when Wall Street releases its annual forecasts, and the financial media absolutely loves them. I'm sure you've seen the articles, and I'm sure you've heard the interviews. So as we've done in the past, we wanted to start by talking about how to think about forecasts because they do show up everywhere. What you're looking at here are Wall Street year-end forecasts for the S&P 500 in 2024 and 2025. So what we're showing here, for example, on this top chart, this is 2024. In the beginning of the year, these different firms made these forecasts. And then, what we're also showing is where the S&P ended for the year. So in 2024, most forecasts came in well below what actually happened. And that's not unusual. Sometimes they're too high, sometimes too low, but they're usually not in range of where the markets actually end up. Now, to be fair, if we look at 2025, I will appropriately give these firms their flowers because they actually got in within range of where the close would be. Still a little off, but I'm good with a range, and they definitely deserve credit. But we need to understand that that's the exception, not the rule. Henry, when you look at these forecasts, how much weight do you actually put on them?
I don't, honestly, I don't put that much weight on it. As you mentioned earlier, it's a Wall Street tradition for leading strategists to produce forecasts, and everyone eats it up. They get a lot of press, but historically, the forecasts have been off target. It's nice to sort of have a consensus of what they're thinking, but generally what happens is that they all cluster together in their expectation because if you're going to be wrong, well, it's better for them if they fail together. And they tend to also, the forecasts tend to be, higher single digit gains most years. That's been the case of late. For 2026, the average predictions, it's up around 10, 11, 12%. But they are clustered. The other aspect of this is that if you call for a decline on an annual basis and you were wrong, that creates a lot of job risk. Uh,
Right.
Bearish and wrong on Wall Street means loss of job. Bullish basically is the standard because bullishness is good for business.
Right.
So, I mean, I try to, I get a consensus. There's some that I think maybe not necessarily that their forecasts are better, but when you're trying to build a case for events expected during the year, some people have, a good sense for things like that. I would also say real quickly here that in my experience, the best strategists have been in their prior career portfolio managers. They know what it's like to run money for real. It's like coaching pilots to fly a plane when you've never flown yourself. Because when you sit, as you well know, Austin, sitting in the portfolio manager seat, our job is not prediction, it's probability and dealing with the reality of life and clients' expectations. And when you're in the strategist world, you are removed from that.
Right. Yeah, and many people don't think about that career risk, right? And how that could impact the predictions. You do find that many firms end up somewhere between a 5 to 10% range from the starting price, right? And I think that's just because they know that's where most people are going to be. Because you don't want to be very wrong when you're sitting in this seat because your job's on the line, right? Even if you're very compelled and you have a strong belief that it may go one way, you're going to be anchored more towards the mean, just as a result of that career risk.
And I'm not saying these, strategists are highly intelligent, serious people, and much of their analysis has merit, but it's the basic forecasting element where they kind of have a leash on them that the managers, the managements of big investment outfits, they like to be optimistic. It's a business thing.
Right. Right.
And it's not to take anything away from the strategists, but the smart money, institutional investors and the like, and retail investors should be fully aware of that sort of conflict that exists there.
Right. Yeah, I completely agree with that. While there's no reliable evidence that anchoring decisions to these forecasts, even the average forecast, leads to better outcomes, in fact, these results, these forecasts are generally less, if you go back and you look at history, they're not even within range most of the time.
Right.
They're in range less than 50% of the time. So you're better off flipping a coin. But at the same time, you know, these are very smart people with very good models. And the issue is that markets don't move based on the models alone. They move based on complex economics, layered on top of human behavior, layered on top of surprises and events that can't possibly be predicted in spreadsheets. So, we should keep that in mind. And many analysts openly admit that they don't treat their own forecasts as precise, prediction tools. They're more about framing a narrative than calling an outcome. I've heard several of them talk about, that they feel that these forecasts are more about a marketing effort, right? To get the firm front and center, just to put something out to clients to make them happy, to get the interviews, to be in the Wall Street Journal articles, et cetera, et cetera.
Exactly. And I mean, some of the ones that are most well known have said publicly they don't enjoy the exercise.
Right.
And I mean, again, for me, I kind of get a sense of the consensus. And then I spend time thinking about what is out there that is likely to make the return be different from what they're forecasting. That what could be out there that, in my case, would be to make the market move higher or lower. But what do we need to be aware of that's out there?
Right. I
And
agree. When you read all of them, right? And not just focus on one particular person. I think it gives you a good summation of all the ideas and thoughts out there. It sometimes helps bring up things or bring things back into light that weren't necessarily front and center for us to think through. But really just kind of painting that picture of where we are today as opposed to where we're going to be in 12 months from now.
Mhm.
Yeah. Yeah. I guess just to sum this up, I feel like expecting analysts to nail where the market will be at 12 months from now is kind of like expecting the weather forecast to tell you what it'll be like on this exact day next year. We can't even rely on weather people to give us an accurate forecast 12 days out or even a week out. How can we expect them to know what's going to happen in 12 months?
I mean, history is filled with gurus that got on a roll and
Right.
then sort of fell from grace.
Right. Or I love when you see the article so and so who predicted the stock market the technology bubble is now fearful because of XYZ, and then you look back on the history of the articles this person's been appeared in, and they've been saying this for the last 15 years.
Right, right.
So if you accepted their investment advice 15 years ago, your returns probably wouldn't be what you would what you would have wanted today.
Mhm.
So, okay. So another big topic, given everything going on in DC and across the world, is political conflicts. And I really like this slide because it's calming while pointing to a very uncalming topic. Henry, can you walk us through what we're looking at here, especially for the folks listening on audio who can't necessarily see the screen?
Happy to, Austin. I mean, we have been getting a lot of questions about the geopolitical developments throughout January. It's like we've had a year's worth of events in 1 month. But with the Ukraine negotiations going on, Venezuela, Greenland, people are becoming more concerned about a crisis of some sort or conflict that would cause the market to decline noticeably. But if you go back in history and you look, we put together a long list here of wars and crises and terrorist acts that the market tends not to be dramatically affected by these events in most cases. If you look here at the bottom, the average return 12 months later is a gain of 7.9%. And I think the most overriding factor here is that the years where 1 year later, let's say, the market had declined, well, the stock market in the US was already in a bear market before the conflict or crisis or terrorist act war began. That there were fundamental financial and economic factors like recessions that had pushed the market into a bear trend already. And let's put it that way, the conflict or whatever did not improve things, but it didn't necessarily make things worse than they already were. And so, I mean, it's just something to, as a human being, you don't take comfort in what's going on out there, but you shouldn't let it overrule, what the probabilities are investment wise. It shouldn't deter you from your long-term investment plans.
Right. And I think that that's important. I think that, especially pointing out that even when we did see the declines 12 months out, that was more associated with a bear market due to fundamental U.S. economic reasons, not necessarily the conflict itself. And, intuitively, and I want to be careful when I say this, but intuitively, while our hearts absolutely go out to the troops and the civilians impacted by war, when a crisis is a war or the crisis leads to a war, from an economic standpoint, wars have historically tended to be stimulative for growth, for the growth of the economy, for the growth of stocks. Not because they're good, but because they drive spending, right? Supplies are needed, equipment is being produced for the troops, and the people, helping and aiding in the efforts. Infrastructure needs to get rebuilt after it gets knocked over. All of this, flows through the economy and ends up adding support. We're not saying that every war needs to lead to a rising stock market, but there are forces that we need to acknowledge that help support the economy when wars do occur.
And if you look, just to reiterate, if you look at the chart and look at the negative years, look at 2001, we had 9/11 and Afghanistan. Prior to that, to the 9/11 attack, the stock market had weakened because of the unwinding of the dot-com bubble. We were in a bear market, and we were also in a bit of a mini recession there. So the stock market had already begun to go down. And having been in the business and actively in the business during that period, I can tell you that in the immediate aftermath of 9/11, the stock market was closed for 5 days, opened dramatically lower, but ultimately it created one of the best buying opportunities in recent history. Probably the most scary part in my lifetime, I was very, very young, but the Cuban Missile Crisis. The stock market had actually been very weak prior to the crisis without even knowing it was coming. There was a bit of an economic slowdown. President Kennedy was in a battle with U.S. steel companies over steel prices. He was really upset because the steel companies raised prices. He criticized them publicly, and actually, very similar to our current president, used some pretty salty language to describe how he felt about it. But all of the stock market had, prior to the crisis, was down, and there was this tremendous reflex rally after the Cuban Missile Crisis. It was almost like it was a big win for the U.S. diplomatically. People liked it. So, it's just, as I say, if the market sells off, it's normally we have a problem already. And right now, the market is, obviously there's a lot of stuff going on, but the market has not given any particular sign to be, red alert, for sure.
Right. I like to think of geopolitical conflicts headlines. They're like thunder over the ocean. Sure, they're loud, they grab your attention, they feel urgent. Markets, on the other hand, though, they're more like the tide of the ocean. The tide moves based on earnings, interest rates, inflation, liquidity, not the loudest noise in the sky. And we need to take that into account when thinking about, how we're going to translate the headlines to how we're managing the portfolio. So,
and all of it comes down to what's the impact on U.S. GDP,
right,
and the day-to-day life here. And while everything outside of that, and in the crisis, and the people involved, and the troops, and all that, is horrible, but the stock market tends to be a different animal, and the financial markets overall are a different animal than what our day-to-day life tends to be.
Right. A high quality, technology company or staples or energy company, et cetera, at the end of the day, regardless if the war's happening or not, is a high quality company, right? And that's what we're investing in. We're investing in quality companies, for their future. And this noise around us can confuse things, but I think at the end of the day, you have to know what you own, and you have to believe in what you own, and believe in American capitalism and the growth that stock investors are rewarded with historically for taking on that stock risk. So, out of curiosity and along those lines, I zoomed out from the first conflict on this list through the end of 2025, and the S&P 500 over that time period compounded at about 11.5% per year. And that's not a cherry pick period, of course. It includes wars, terrorist attacks, oil shock, political crisis, and recessions. So the question I always come back to is this, right? if long-term equity returns already do what they're supposed to do, right? Through all of this mess, the US stock market was up 11.5%. So if they're doing what they're supposed to, why try to time the market around fear when you don't have to, right? To beat an 11 plus percent annualized return, you don't just need to get out of the market at the right time, right? You also need to get back into the market at the right time. And there's absolutely no reliable research showing people can do that consistently and earn a profit competitive with a more simple buy and hold strategy. In fact, the research says quite the opposite. The research says that market timing has been one of the larger detractors to investor returns on average, pretty much year after year.
I mean, 25 years ago, Warren Buffett made the comment that, for 225 years, it's been a bad idea to invest against or to bet against the United States, and now's not a great time to start. I mean, I think he would say the same thing today, that
Right.
that there's a special character that we have as a country constitutionally in our brand of capitalism and rewarding entrepreneurship, capital raising, transparency. We have our flaws, but it's the best out there.
Right. And look, I get it, everyone. We're naturally drawn to the idea of market timing or trying to control things. That's just how our brains are wired as human beings. We want to react when something feels urgent or scary. We want to feel safer. We feel safer when we feel like we have control over our destiny, right? So that means making changes, this and that. But if investing success truly required reacting to every frightening headline, none of us would be here. We'd all be sitting in cash since the invention of cable news. Negative news gets more attention, and we're going to see more negative news than positive news because attention drives ratings and ratings drive advertising dollars. But what grabs headlines doesn't translate into better long-term investment results.
Ultimately, the most important thing in investing is the price you pay for the investment.
Right.
Everything else is noise.
Which is a very, very good segue to another another pretty big topic coming across our desks these days. Let me flip to our next slide here. All right. So gold and silver. This is the chart everyone's been sending their friends lately. Now, there are three important words at the top that I just want to point out, adjusted for inflation. So this shows the real purchasing power, not just price in dollars, in terms of how the prices of silver and gold over time, looking back. Okay, and what jumps out immediately is that these metals don't move smoothly. They move in episodes, big spikes followed by drawdowns and long cooling off periods. And you can see in the chart major peaks around 1980 and 2011, and then meaningful drawdowns after both. And I didn't get a chance to look up exact headline articles leading up to this, but I have to believe there were some pretty bullish silver and gold articles during the run up in the 70s that led to that peak in the 80s and then again in the early 2010s, right?
Oh, for sure. I mean, gold has a sort of manic depressive history. I mentioned this before, but my first year in the business, 1980, gold and silver were going through the roof. The Hunt brothers tried to corner the silver market, and there was a tremendous short squeeze, but ultimately they were crippled and basically lost, blew their
Right.
fortune as a result of margin calls, and the price collapsed. But there was a huge popularity for precious metals. The firm I worked for, the most famous analyst in the place was our gold analyst, who had, people felt he walked on water, and but he eventually fell below the surface. But gold has a really sort of it's an interesting lesson historically. It really opened up as a market in the latter days of the Nixon administration because prior to that, gold was linked directly to the dollar. that the dollar could be exchanged for gold, and gold was basically fixed at a price. And that ended during the Nixon administration. And as you can see, combined with the inflation there, prices took off. And we're in another situation now. It's look at the chart. I mean, it's quite incredible what's happening. But there is a real boom bust nature to trading precious metals.
Right. And if I could step into the shoes of the Hunt brothers, right, you have to believe they felt like gods for a while. They went from feeling like the smartest people in the world to everything collapsing in almost the blink of an eye. It's kind of crazy to think about.
I mean, I'll tell you, Nelson and Bunker Hunt were not, I shouldn't say this, but they were really spoiled and undisciplined.
Mhm.
H.L. Hunt made all the money. These guys tried to lose it throughout much of their lives. The one that survived the best was Lamar Hunt, who bought the Kansas City Chiefs football team. He kind of saved the situation. But it's like people power and they kind of lose their money. They just get greedy and they lose their focus. There was no reason for them to try to engage in that trade. They had oil revenue just forever, and they compromised the whole thing. And unfortunately, in situations like that, the smaller investor at the end tends to fall into that trap. It's like the people earlier to the party who know when to get out do well, and the people that get there late, they get, as the saying goes, they get left holding the bag. It's just it's a highly speculative situation. In the early days of these rallies, particularly, let's say, looking back a couple of years ago, there's always a fundamental reason for why gold starts going up in price,
Mhm.
but no one really knows it. This time around, it was the central banks began to buy gold. The dollar is down 11% since the beginning of Trump's second term. Gold is up 84%. There was a high degree of uncertainty with tariffs and you name it, but there seems to have been some loss of confidence in the dollar, and central banks started buying and price started going up. Then people are attracted to the price momentum. They look at the chart and say, boy, this thing is going up like a rocket ship. And that's kind of what happened.
Right. Right. And something I don't think many people appreciate, but I think it's key to understanding these types of sharp movements and how, like you said, a seedling of some fundamental reason for upward price momentum. And that scarcity cuts both ways. Right. And now that I've kind of created that visual, one data point that really stands out to me from last year was the amount of money that flowed into gold ETFs. Global gold ETFs saw roughly $89 billion of inflows in 2025. That's the largest annual total on record. That's more than 20 times the amount of inflows we saw in 2024. And when you see flows of that magnitude, it raises a fair question. Is that money being driven by fundamentals, or is it being driven more by narrative and speculation now? And that distinction really does matter.
It matters completely. And when you get into a situation, I hate to use the word bubble because they call everything a bubble, but this is sort of what they would call a speculative episode.
Mhm.
I can tell you that people that have bought gold of late, they may cite fundamental reasons, but they're only in gold because this price is spiking higher. If it wasn't happening, they wouldn't be there. And it's just, as I say, it's a pure betting kind of situation now. It's like going to Las Vegas, being at the gaming table. People need to know when to fold, and it's honestly the people that got in early and the smarter people that are going to pass it on to the people that are going to buy at the end and lose. And you can see here that when silver and gold sell off, they pretty much lose all of the gain that they had going into it.
Mhm.
It's permanent loss of capital. In the stock market, well, you may sort of buy I don't know, name a top U.S. company. You may have timed it wrong, but the value of the business increases over time, and long term, you're not going to lose money. But in this situation, it's just like, yeah, go to Monmouth Park for the afternoon and have some fun. I mean, this is just not, it's not investing.
Right. Right. And I completely agree with that. When you're investing in a company, you're investing in something that has earnings power, et cetera. When you're investing in gold and silver, you're just investing in gold and silver, right? There's no earnings behind it. You're paying whatever you want to sell it for is whatever everybody else is willing to buy it for, and vice versa. Um, and I liked that you brought up how a lot of investors will say that they're investing in gold and silver as a equity hedge. If you're out there and you're investing in gold and silver and you're saying you're investing it as a hedge, but then you're looking at your statements and you're expecting and wanting stock like upside returns, then you're not really investing in gold and silver as a hedge. That's a good gut check. It's funny, you invest in as a hedge, but then you look at it and it looks more like a crowded trade than anything else. I don't know. But so we talked about gold and silver, on the other hand, that does have more supply than gold, but the same basic supply constraints still apply. When demand surges suddenly, prices can move very quickly up or down as the market works to rebalance a sharp supply and demand mismatch, which leads to these meme stock type movements.
I mean, silver is a little bit of a different animal in that it has industrial usage
Mm-hmm.
and that there is a supply deficit now. But silver goes into solar equipment, AI, a lot of stuff. And there is a supply deficit, but this is taken on a parabolic move, and it's kind of outrun any sort of fundamental pricing element, even with the supply deficit. It just
Right.
and look, I mean, we would both admit silver could go to 500. I mean, I don't know. I mean, the market does crazy things. But from our standpoint, it's just not. We're not here to make bets. We have fiduciary responsibility.
Right. And you mentioned the supply deficit. Yeah, it's worth noting that there's almost a self-healing mechanism in there. When there's a supply deficit, silver prices go skyrocket, right? I buy some silver, I own it at, let's call it $100 to keep the math easy. Especially if it's heightened levels, right? Companies out there who need to use silver in their process and their products, they're going to demand that silver prices come down, right? And the silver providers are going to be making more silver. So as more silver is made, the price that I paid for that silver, should theoretically go down as that supply demand mismatch corrects itself. So it's not like a stock where you're buying into future earnings and you can expect that to go up. No, you're buying into something that the market forces are going to have fluctuate, just based on, natural happenings, within the market.
And you see signs in the background. People are lining up to like sell their family silver. They did the same thing back in 1980. It's just there's a psychological element that
Right.
that comes into this. But history is filled with lessons of, as I said earlier, boom and bust. And that's the character of silver and gold.
Right. And
One factor I think that has contributed to this is that it was hoped that Bitcoin would sort of provide an element of store of value. And Bitcoin has been very weak for the last 6 months. It hasn't served that purpose. So there's an element of investors that might have been attracted to Bitcoin that made the move to gold because there are elements of Bitcoin that have there's an element of there's some shady characters that have tended to be involved there. And there was sort of in a sense, a flight into Bitcoin that in many ways was similar to what's happening in gold and silver now. But people have lost confidence in Bitcoin.
And we had a question come in: could prices keep going? Sure, would be my answer. We don't know, and anyone who says they do is lying to you or themselves, regardless of whatever investment thesis they put in front of you. What we do know is that gold and silver has already had a very strong run. And as seen in the historical chart, you know, a great recent stretch doesn't automatically mean a great long-term forward return from today's prices. A big recent run-up has often been simply just a sign that you're paying more, you're paying a higher admission price for future volatility. But we'll see. We'll see how it plays out. How long this could go up, when a turnaround would happen. That's all. That's all in the unknown.
What we don't know is how high it can go. Um, there's just no way to figure that out when a speculative momentum and a thinly traded item happens. As Austin said earlier, it's like the meme stock situation. But what we do know historically is when it drops, it's going to go down a long way. And that's kind of the reason that it's not, as I said, it's a speculation at these levels, not an investment. And anybody entering would have to be fully willing to accept that you've got a lot of risk of downside.
Right.
And but we could go to 10,000, something like that. The market background here with the dollar and the Fed and all this sort of stuff, it's got a momentum here. But as portfolio managers and custodians of assets, it's just not our way.
Right. Right. And there is research that suggests that if you hold like a certain allocation to gold and silver, right, at a consistent level and rebalance it year after year, that can be productive for a risk return pattern. But what we find is that most clients can't handle the volatility. All right. If whatever percentage they choose when we're in an environment like today, that percentage isn't enough. And when it comes back to, it's too low. And when it comes time to rebalance that, they don't want to, right? When uh, gold and silver are moving in the other direction, the allocation that they chose is way too big, and they don't want to rebalance it back up. Okay, so we find that gold and silver can be better, wrapped into the financial system of itself, and that many clients just don't have the wherewithal or the discipline, and that's not a diss on anybody, because I think it's human behavior, but the discipline to hold gold and silver in that type of manner.
Trading things. It's it's a very difficult game. Very few people are able to do well. It takes incredible discipline and like managing your bets at the poker table. It's a different game. It is not investing. And playing a trend like game is just it's really tough.
And so I looked back out of curiosity, and I said I looked back at a gold index and a silver index as far back as those indices went, just out of curiosity, and said, all right, well, what have the long-term returns on average been? And what you'll find is gold and silver have averaged mid-single digit annualized returns over long multi-decade rolling periods. So we've seen impressive returns over the last few years. Would the prior long-term history point to a reversion to the mean, time will tell. I think based on asset that is primarily focused on supply and demand, it would need to revert to the mean eventually. But like we said, when that occurs is anyone's guess.
There are many times where, in difficult situations, gold has not been a hedge. It just hasn't moved. It
Right.
hasn't worked. And in a crisis in modern history, the best hedge is your bond allocation. Most effective. There's a flight to high quality bonds in a crisis, particularly here in the U.S. It's not gold. So again, this is just it's a speculative situation. It draws a lot of eyeballs. It's just the character of markets. We go through these phases, and it involves not just gold. It could be soybeans, beanie babies, you name it. It's just that's the game.
Right. Right. And as you mentioned before, that seedling of what started this run, right? The dollar devaluation. That also carries through to other asset classes. The dollar weakening helps support or create a tailwind for other asset classes like international. And international had a very strong year last year, up roughly 30 to 40%, depending on the index you're looking at. And they've had a solid few weeks to start this year. So let me pull up a slide on international here. So international stocks. This next slide is showing us U.S. stock performance versus international stock performance. And it does a great job portraying how cyclical returns have been and the impact of dollar strength. So for anyone listening on audio, this chart shows us a long history going back to 1975 of who's outperforming who, U.S. or international. When the blue line is above zero, the U.S. is outperforming international stocks on a 5-year rolling basis. So, for example, here, and when it's dipping down right below this line here, on a 5-year rolling basis, international stocks is outperforming. And the big picture takeaway is pretty clear. The U.S. has had a very long stretch of outperformance, largely since 2011. When is that going to change, right? And then one thing that is important to notice, the gray line, let's get this out here. So the gray line here that's coming up and down as such, the gray line is showing us whether the dollar is weakening or strengthening versus other currencies. And historically, when the dollar has been strengthening, so that gray line's going up, you'll also see the blue is going up, right? That is providing a tailwind for U.S. stocks. When the dollar is weakening and that line's going down, you'll notice that that's providing a tailwind for international stocks. So in an environment where the dollar's weakening, right, it makes sense that we saw the performance we did have international. There are other factors in there as well. For example, our friends overseas, our economies overseas are starting to spend more money on themselves. Part of that is the U.S. pulling away some resources. Part of that is them just deciding to step up to the table and spend more money on themselves, which is helping their economies. But it is important to consider the impact on the dollar, right? It's not just impacting gold, it's impacting all these other asset classes, including international. And it's not something that's carved in stone. But it's something that we need to consider when thinking about diversification and where we're going to rely on returns and what our opportunity set looks like.
Exactly, Austin. I mean, this really is it's an asset allocation picture that historically the U.S. versus international, whether you're outperforming or underperforming, as you can see here, they're long cycles. And as money managers, we're aware of the phenomenon. It's sort of reversion to the mean return, mean valuations. There are periods where the U.S. market is undervalued and embarks on a long period of outperformance, and vice versa. And what we're seeing here with international starting to pick up late last year, and incredibly so. I mean, that in emerging markets on the index up over 30%, just big gains for all the major international indices. Given the length of time these indices have underperformed versus the US, you might expect that we are embarking on a period that you will want to be certainly have exposure to international and be thinking within your allocation of if you have a target, make sure you're at your target. As I said, this is just cyclical uh, reversion of the mean, but we're in a situation now where international indexes are valued more attractively or cheaper than the US. It doesn't mean that the US is going to go down, but perhaps the returns for the foreseeable future will be, you know, less than international, or maybe comparable, but not this major outperformance that we've witnessed in recent history.
Right. This isn't a call on what's going to perform better, U.S. or international. It's a comment or an illustration on why it's important to be diversified, why it's important to have a large opportunity set that you're investing in, and not just restricting yourself to the largest names in the U.S. stock market or just the U.S. stock market alone. And a common kickback I find when talking about diversifying international is clients will say, well, when you look at the products I'm using, right, you look at who's changing the world, those are US companies for the most part. Uh, and sure, it is right now. Yes, that is the nature of why when you look at the global index and you look at the top weighted companies by market value, a lot of them are US stocks. But I think it's important to remember, especially in an environment where these other countries are investing in themselves more, is NVIDIA, for example. It only took NVIDIA about 5 years to go from less than 0.5% of the global market cap weighting to where it sits now as one of the largest positions in the index at almost 5%. So it doesn't take very long to see that shift. We're not saying that shift needs to happen, but what we're saying is, a good company doesn't need to be just a US stock, right? There could be good companies. A good company can grow and mature from, any of these other economies overseas.
I think you're seeing also that big institutional money, they're starting to change their allocation more towards international. The
Right,
endowments, the hedge funds, the big professional money is starting to move money out of the United States.
right,
And it's an allocation readjustment. It's not that they're going to abandon the United States, but they see from a value perspective, and now even a price momentum perspective, that there's a point to readjusting their allocation to raise international.
right, right. And we had a question come in about where would you overweight expecting a weakening dollar, which is a fantastic question. I mean, international is one, but what I would throw out there as a way to not answer, but answer the question, what I would throw out there is the weakening dollar is one factor of many. Just because the dollar's weakening, for example, doesn't mean international has to outperform. It means there's a tailwind. As a US investor, when I invest money overseas, I'm investing in two things: the earnings of the company, and then also the currency that the company is using, right? Um, and that could be helpful, but there's still the earnings of the company, right? So we have to be, careful not to overweight based on expectations, especially when they're rooted into one theme or factor. And to your point, Henry, talking about where should your base international allocation be, and then how do we rebalance around it? Because that's really how you protect yourself from seeing one thing play out and taking too harsh or too big of a stance, in one direction on that. Because at the end of the day, that dynamic could always flip, or that dynamic could continue to play out as you expected, but there could be other factors that come in, which happens very often, that make it so the implications of that one fact, that initial factor, get washed away, right, and muddied, and you don't actually see what you expected play out, even though you were right in the call on the dollar continuing to weaken.
And again, I just think it's that the dollar weakening, it's not always like a sell signal for the United States. If the dollar weakens here, the threat is a weaker dollar often means higher prices here in the United States, and commodity prices, not just gold, but broader commodity prices have taken off so far this year. I mean, the Dow Jones Commodity Index is up about 8% so far in January. You're seeing commodity price inflation occurring here in the United States, and then that might impact Fed monetary policy at a certain point. I mean, there's certain those the Fed policy and is probably if the Fed was forced to raise rates because of rising inflation that's not expected, it would shake up things here. But we're not in that situation now. The U.S. is entering the fourth year of a bull market. There's the market is not limited by age and scale of an advance. There are a lot of positive things here in the United States underpinning stock prices. Very, very strong earnings. Inflation right now is in check. So we're not saying make a big tactical move away from the United States. It's just readjust your allocation a little bit. And if you're putting some money to work this year, don't forget international and a broad developed market index and a broad emerging market index. There are ways to do it.
Right. Right. If you walk away from this webinar saying, wow, Withum Wealth is really bullish on international, I think you probably walked away with a misconception what we're trying to say. What we're trying to say here is there's strength here. There's dynamics that are working in its favor. Let's make sure that we have that base allocation in play, right? Let's make sure we have that wide opportunity set, and stay diversified. So we only have like 5 minutes left. So I want to cover U.S. small and mid cap, because that's another area that has also shown some great performance recently. Quietly, may I add, you don't hear many people talking about the fact that small cap stocks have outperformed large cap stocks over the last 12 months, but they have. And there's a lot going on in this slide, and we don't have much time. But let me just point out the broad details here. What we're looking here on the left is valuation. So all these lines are different. So, for example, the red line, that is the forward price to earnings ratio for the S&P 500 large cap stocks. Okay, so how rich or how attractive do valuations look? When the line is rising, valuations are becoming richer and richer. When it's falling, valuations are becoming more attractive. When we look at the blue line, that is mid cap forward PE. Okay. And then the green line, that is small cap US stocks PE. And what you find is for a fair amount of the time, valuations will cluster together. Valuations will look pretty similar. And, in many cases, you'll see that small and mid cap valuations are richer than large cap valuations because of their enhanced earnings power and growth and projected growth. But what you find in the last 5 years is large cap earnings have been a lot richer than small and mid cap earnings. Very similar to back in the early 2000s, which we know that was the technology bubble. Okay. But we've seen this occurrence for quite some time right now. Now, if I can bring your attention to the right-hand chart, what we're looking at is whether mid-cap stocks outperformed large-cap stocks or small-cap stocks outperformed large-cap stocks. So the blue line is, again, mid-cap stocks. And when the blue line is rising, that means that mid-caps outperformed large caps. When it is falling, that means that large caps outperformed mid caps, and then the same for small caps here with the red line. What I want to direct our attention to is when we combine both charts here and we say, all right, well, what happened last time valuations looked like this back in the early 2000s, where large caps were much more richly valued than small mid cap. And we look at the performance chart here, that actually kicked off a long period of outperformance for small caps and mid caps. Okay. Not to say that that trend needs to happen or we're going to see that trend start to change right now, but we do need to keep in mind where valuations are, right? We need to keep in mind the cyclical nature of the stock market, right? And how we're coming off of a long stretch where large caps have outperformed. And it doesn't point to, hey, I need to double down on my small and mid cap exposure. But in my mind, it points to let's make sure we own some. Let's make sure we have some of that opportunity set, and we're not going to miss it should that happen.
That's exactly right, Austin. I couldn't say it better, but again, it's the same principle. It's long-term reversion to the mean that's going on here, and it just means that it makes sense to have an allocation to small cap stocks at all times. It's part of diversification. And one of my favorite sayings is that Mike Tyson, who said, everybody has a plan until they get punched in the face. Well, that's what asset allocation is all about, because you might get cut, but you're not going to get knocked out. And so there's long-term merit in terms of margin of safety and all sorts of things for diversifying your investments throughout areas that have investment merit, but they don't all participate in the same way at the same time. But over time, it's a much, much smoother, less emotional ride.
Right, right. And there's many factors: reversion to the mean, valuations. There's also, as rates come down, that helps small and mid caps. It helps their bottom line because a lot of small and mid cap companies, a lot more than large caps, have floating rate debt. So as rates come down, their debt payments go down, which automatically increases their bottom line just from that happening. And then, valuations, they're intuitive on why they should work, right? We'll never know when, but they're intuitive in why they should work. It's like sports betting, where if everyone thinks the same team's going to win and all the money's flowing in for this one team to win, then the expected payout, because the odds change, the expected payout gets smaller, right? So as these larger cap companies, as their valuation goes up and they exceed earnings, or, they do something to impress the stock market, the payout for that theoretically should be less, right? But for small and mid caps, where that's a place where a lot of people have ignored for a while, should that start to exceed expectations, there could be a greater reward in that area.
Mm-hmm. Makes sense. Makes sense. I mean, I know we're running low on time, but do we have time for a couple of questions? I know one came in about, I think the question was, is the market ignoring Trump's tariffs and fight with the Fed? I wouldn't say the market is ignoring it, but they sort of know what's going on here, that Trump will push and push and push. But his barometer is the U.S. stock market, and he tends to pull back when the stock market has a fit. And I think we are, as investors, the markets at least, they are taking some comfort in that. But it certainly is something, particularly with the Fed, that if the situation and the soap opera there deteriorates more with the new pick and policy down the road after Powell retires, that's something that everyone's going to have to keep a watch on.
Right. The traders are calling it the taco trade, right? Trump
Right,
always chickens out.
right.
Not something we came up with, but something that has been talked about on the street. And that, Trump cares very much, or seems to care very much, about his legacy, about and he correlates that to how well the market performed while he was in office. It appears, so that anytime there's been a strong sell off, he has reverted back and has come back and either adjusted his stance or pulled back on certain words, verbiage, that then the market sees as more optimistic or at least less painful, and we see that rebound. Those
Say what,
thresholds, yeah,
yeah, say what you want. I mean, one asset in the Trump administration is Treasury Secretary Bessent, who is a legendary macro trader. No one knows more about the currency markets than Scott Bessent. He
mhm,
was part of the trade with Stan Druckenmiller and George Soros years ago that basically broke the pound. He knows how to play the game, and it appears the president listens to him. So
right,
I take a degree of comfort there.
right, right. Now, I wouldn't rely on the taco trade, so to speak, existing indefinitely for the rest of Trump's term. I mean, there are thresholds to that, right? There are breaking points, and the market could still have some pretty big reactions to, some of this extra noise that's being created. What seems to be the Trump administration's negotiation tactics.
I mean, at some point, he may wear us all out and we surrender. But I mean, it's just the market has this crazy capacity to discount stuff, and we're seeing a lot of that now.
Right. Right. So we're almost already 5 minutes past. So let's end it here. I just want to thank everybody for tuning in. What we have on the screen here is the link. If you use that QR code to our podcast, you'll find the recording of this webinar when it comes out, along with other interviews where we're interviewing people from across the industry. I mean, we're interviewing people that you'll see on CNBC or Fox News, right? People who they're strategists. They spend their times researching the markets and the economy and talking about it. A lot of great stuff. And then there's also financial planning podcasts that we put out that talk about key financial planning topics for individuals, both basic things that we should be reminded of, and then also when things change or when things are expected to change, we post updates on that as well. So I encourage you to go find us. The podcast is called Amplified Wealth. It is on YouTube and all of your favorite podcasting apps. If you follow on any of those channels, what will happen is you'll get an automatic update on your phone when we post a new episode, which can just be a cue to say, hey, is this something interesting that I should listen to? It's a great thing for passing some time, whether you're walking the dog or driving the car or working out. But thank you all. Thank you for listening to that shameless plug. And we will see you in about another quarter.